Hey guys, welcome to my channel Investing Untangled. I wish you all a very happy new year and I hope you're all doing great. So in today's video, I'll be discussing and analyzing a company which I think is very undervalued in this expensive market today. So I came across this company a few days back and I've been analyzing and researching it since then, and I found that they've posted actually great numbers in the past. This company has grown very quickly, its revenues, its earnings, and its book value, and I think they have a great future growth potential going forward. So people with a very long-term investment horizon in mind, this might be an interesting opportunity to look at. So let's check out which company it is and let's go deep into its analysis now. Okay, the company that I'm going to analyze today is National MI Holdings, ticker NMIH. So I'll explain to you what their business model is. So I'll run a qualitative analysis, we'll check out their management team. I'll also do a quantitative analysis to understand what their financial situation looks like. I'll also run valuations to figure out if this company is undervalued or overvalued right now. And I'll also finally run risks versus reward situation in this kind of an investment to understand if this is a good buy right now. So National MI operates in the private mortgage insurance sector, and it was founded in 2012 and it went public in 2013. Its market cap is $1.9 billion, so it's considered a small market cap. And the way that these companies make money is by insuring housing loans. So they protect the lenders. So if a borrower defaults on his mortgage, the lender is protected, and these private mortgage insurance companies cover up the losses for the lender. And as per government regulations, any housing loan with less than 20% down payment should be insured. And these kind of strict regulations were put into place after the financial crisis of 2008. So the biggest player in this sector is actually a government agency called Federal Housing Administration, which insures these housing loans and works with multiple different lenders. But over time, their market share actually has been going down steadily, and this has led to many private players actually expanding their business in this space. So many private players like Radian, MGIC, Essent, and National MI have been expanding their businesses in this sector because FHA has been losing its market share. National MI Holdings was started in 2012 by Bradley Schuster, who served as the CEO from 2012 to 2018. And prior to starting this company, he actually has worked in this sector for quite some time. So before this, he actually served as a Chief Executive Officer of the PMI Capital Corporation of the PMI Group. So he has actually had a lot of experience in this field. And their current CEO is Claudia J. Merkel, who took over as the CEO in May of 2018. So she also actually joined the company in 2012 when it was founded. So this is something that I like, when the founders are still associated with the company and the CEO has actually had a pretty long run at the company, which is good. And I also found out that National MI has been actually rated as a great place to work at. So this is actually good. This shows that the management team is doing a good job at ensuring employees' satisfaction. And these are great traits of really good businesses. Okay, now we'll perform the quantitative analysis and look at their financials. So I'm on the Morningstar web page and I'm looking at the NMIH ticker here, the company financials. So here I start with the revenues, and you can see their revenues have pretty steadily been going up from $6 million in 2013 when the company went public, and right now they stand at $430 million, which is a great growth. Next thing is net income, and this company became profitable actually in 2016, and since then it has shown a very steady increase in net income from $66 million in 2016 to where it stands right now is at $173 million. Book value per share is also very important for especially insurance companies to assess if the business is growing or not. And you can see that their equity has been actually growing pretty strongly. So book value per share, 7.70. They started off in 2013, and then now it is actually doubled. It's at 15.42, and it has been consistently going up, which is good. And then you look at operating cash flow, and this has also been going in the right direction. They started generating positive cash flows in the year 2015, and since then they have increased them pretty massively. So right now they are at $284 million, and they started at $41 million in 2015. And free cash flow has also been growing pretty rapidly from $35 million in 2015, and now it stands at $272 million. So this shows a pretty steady growth in their business numbers. So let's look how profitable the company is. So I look at net margins, and you can see ever since the company started making profits, the profit margins have been actually really good. I like profit margins of around 10 to 12% or above. The higher the better, and you can see that these profit margins are really good. So this, for example, means that 40% of the sales money is retained as profits in the company, which is great. And finally, looking at return on equity, you see that return on equity has also been pretty good, and it has been close to 15% or above, which I like. And now we'll look at the financial health of the company by clicking the tab here. And here I look at the debt to equity ratio, and if it is below 0.7, that's when I'm interested in the company. That shows that the company has very little debt relative to its equity, and you can see that NMIH has actually maintained very little debt from the very beginning. So the ratio has been below 0.7 consistently. So financially, this company looks very strong. Alright, now we'll assess the impact of the current economic distress on this company, how much of their income was hit and what is happening now. So these are the results from their second quarter, and these are the results here from their third quarter, and this is the third quarter from 2019. And you can see here their net premiums actually increased compared to the last year. So they stand at $98 million for both quarters. And now where you can see the difference is actually in claims. So while in 2019, when everything was okay, the claims were around $2.6 million, but for the second quarter of this year, you can see that the claims actually jumped to $34.3 million, which is quite a lot. But the good thing is that the numbers have started going down. They stand at $15.7 million, which suggests that the company is recovering. And because of these claims, the company did take a hit on their net income also. So you can see the third quarter last year, they brought in $49.8 million as their net income, while that got impacted quite a lot in the second quarter of this year, but it has actually stabilized and has started to recover a bit, and now stands at $38.2 million. What is also interesting to look at is that their shareholders' equity, or book value per share, has actually increased despite the current economic conditions. And the most important thing to look at here for an insurance company is the loss ratio. So the loss ratio actually assesses what is the amount that was paid out in insurance claims and claim expenses in relation to the premiums that were earned. So the higher the claims, the higher will be the loss ratio, and the higher the loss ratio, that's actually not good for the insurance company. That means that the company is losing a lot of money in claims. And you can see that for 2019, at the end of third quarter, the loss ratio was actually very low. It was 2.8, and it jumped to 34.7%, which is a massive jump at the end of the second quarter, which was kind of expected. But interestingly, this ratio has been actually going down. It is at 15.9%, which again suggests very strong recovery. It is still higher than what it was last year, but it has come down quite massively. And the expenses associated with the claims and insurance policies have not changed that much, so they are in the same range, and that's what expense ratio assesses. Okay, now I'll show you some numbers from their Investor Day presentation that happened recently. So here you can see primary insurance in force, which is actually active insurance policies, has increased quite significantly all the way from 2015 to 2020. Year after year, there has been a significant increase in the growth of active insurance policies, which shows that their business is growing. And here you can see actually many of these PMI companies struggled during the pandemic because a lot of borrowers defaulted on their loans, but you can see that NMIH has maintained a very low default rate of 3.78%, and these are the other competitors, other private mortgage insurance companies, where the default rates are much higher than NMIH. So this shows that the business of NMIH has not been drastically impacted. And now looking at some more numbers, you can see that active customers have actually increased pretty significantly from 855 in 2017 to 1,167 currently. And the new insurance written has been increasing, which means new insurance policies are being written. And this I showed you already, that primary insurance in force, which is active insurance policies, have also been rising pretty steadily. So all these numbers show that their business is expanding in a steady way. So now we'll look at what kind of parameters companies look at, these private mortgage insurance companies look at before they insure a housing loan. And the major parameters they look at are LTV, which is loan to value, the FICO score, which is the credit score, and DTI is debt to income ratio. So loan to value basically is the amount of loan in relation to the property value. So the lower the LTV percentage, the less risky the loan is. And you can see that NMIH is actually the most conservative across all these PMI companies. So these are the other competitors that it has on the market, and NMIH is actually the most conservative in terms of managing risk. So it only has 4% of loans that are insured in its portfolio that are 97% LTV. So the next thing is the FICO score, and you can see that NMIH is also very conservative here. It only has 1% of loans where the credit score is less than 680. It only has 1% of these loans insured in its portfolio, which shows that it is extremely conservative and they try to avoid risky loans, which is good for their business. And finally, they also look at DTI, which is the debt to income ratio. The higher this ratio, the more debt an individual has, and they are also very conservative here. They only have 7% of loans in their portfolio where the borrower has more than 45% debt to income ratio, meaning that they're very conservative on this parameter also, and they only insure loans with very low debt to income ratio. And now here you can see what is their average FICO score of the loans that they have insured, of the housing loans that they have insured, and it is 754, which is considered very good. And you can see with the reduction in the credit score, there is a reduction in the percentage of loans that they insure, meaning that they are again very conservative and they do not insure loans where the borrowers have lower credit scores. So this is an interesting piece of information that I came across in their Investor Day report, where this shows that borrower reliance on the government forbearance programs has actually started declining. So you can see around the peak of this pandemic situation where a lot of people could not afford to pay their mortgages, so they had to rely on these government supported forbearance programs, but that has started coming down now pretty steadily, meaning that people are able to resume their mortgage payments. So this suggests that this PMI sector that was actually hit very strongly because a lot of people were not able to pay their mortgages, so this sector will be recovering rather soon, hopefully, and these companies will be getting back on track soon, which is great news for a company like NMI Holdings. So another thing that I want to show you here is why this PMI industry and these companies might be actually doing good business going forward is because of these numbers here. Because the interest rates have actually dropped quite a lot, so it's at an all-time low right now. So all-time low mortgage rates, you can see that 30-year fixed mortgage rate has gone down to 2.8% now, which was at 4.5% in 2018, and now it's at a very low percentage, which means that a lot of people are actually inclined towards buying homes now, and they want to take a mortgage, they want to take a housing loan and buy property right now because the mortgage rates are extremely low. And this has actually resulted in an increased demand in 2020 of house purchases. And here you can see there is an average 25.8% increase in the demand and real estate purchases in 2020. And what that has actually caused is that there is reduced supply now because the demand is so high. You can see that housing supply, monthly housing supply has actually gone down. So now we'll look at how the stock of this company is valued right now, if it is undervalued or not. So we'll look at the valuation. So in Yahoo Finance, I go to statistics, and here you can see the forward PE of the company is right now at 10.21, which is extremely low given that the market is extremely expensive right now. And the company trades at a price to sales multiple of 4.11 and a price to book multiple of 1.52, which also suggests that the company is undervalued. These are really good numbers. So Yahoo Finance does not have the PEG ratio here, so I calculated my own PEG ratio. And for calculating the PEG ratio, I obtained the earnings growth rate, the anticipated earnings growth rate from Simply Wall Street. If you go to future growth, you see that the analysts here think that the company will be growing its earnings by 19.1% annually. I came up with a PEG ratio of 0.53. So price to earnings ratio divided by earnings growth, that is the formula for calculating PEG ratio. This gives me a PEG ratio of 0.53, which shows that this company is extremely undervalued. So PEG ratio of below 1 is very, very good for investors, because this shows that the company is very undervalued. And I'll put all these valuation ratios right here. So I also obtained price to free cash flow, which stands at 6.3. I like to invest in companies where price to free cash flow is less than 10, and here you can see it is much less than 10, which again shows that it is right now at a discount. Price to earnings, it is 10.21. Price to sales 4.11, price to book 1.52, and PEG ratio, which we just calculated, it is 0.53. So all these ratios actually suggest that this company is significantly undervalued. So the analysts suggest here that the company is significantly undervalued. It's more than 50% undervalued, and they estimate that the fair price for this company is $49.77 per stock. And right now the stock price is 22.65, which is very, very undervalued. If you go to the DCF calculator on this website, you can actually input the free cash flow that I obtained from Morningstar, and this is in millions, and it asks you what the growth rate, expected growth rate is, and I took it from simply Wall Street again. The future growth rate estimation is 19%, but I want it to be very conservative, so I dropped it down to 15%. So remember, the more conservative you are in your calculation, the better it is, because this is all an estimation for future growth. And then it asks you, what do you consider short term? I leave it at 10 years. And what discount rate do you want to use? So I will start with a 10% discount rate, and I leave the perpetual growth rate at 3%. And how many shares are outstanding? This information I took from Yahoo Finance, and if I hit calculate, it actually gives me this intrinsic value of $119, which is way more than the current stock price. So, and this means that at a 10% annual discount rate, the company fair value is $119. So what if we want to get a higher rate of return? So in this case, if we just put in 15, this means we'll get 15% rate of return on our investment annually. And let's see what the intrinsic value looks like now. So at 15% discount rate, it says that the intrinsic value of this company is $60 per share, and the company price, the stock price is right now significantly lower. So this suggests that the company is very undervalued right now with all these different methods that I used. So far everything looks good. The financials of the company look good, the growth rate looks awesome, and it looks like the company is extremely undervalued right now. The only red flag that I found in my research on this company is that there has been a lot of insider selling, which is not a good indication, and I'll show you how I find this. So if you go to Guru Focus and type in the ticker NMIH here, I'm already on their page. This page will pop up, and if you go down here, and here you see the insider trades, and all these red bars indicate that insiders actually have been selling shares. This is not a good indication. So this is the only red flag that I found in my analysis, but other than that, everything looks really great with this company and with all the financials, with all the analysis that I did. Okay, that completes the analysis. So now we'll think about risk versus reward in this kind of an investment. So the reward here is that it's an extremely undervalued company in a pricey market, and at some point the stock price will catch up with the growth of the company. But the risk here is that right now the economy is in distressed condition, and these PMI companies generally flourish in a very strong economy, because people have money and they'll invest it in housing and real estate, and their businesses do well. Right now the housing market has been going up because of low mortgage rates, but once the economy completely recovers, that will actually boost the sales of these companies even further. If you got value out of this analysis, please consider leaving a like and subscribe to my channel, Investing Untangled. This pretty much wraps up this video. In my next videos, I'll be posting a lot of new stock market related research and company analysis, so stay tuned for that, and I'll see you in my next video.